Markets moved today as investors reassessed a key assumption about the global energy crisis, shifting from a fear of total shutdown to the possibility of a diplomatic exit. Under the surface, today's rally wasn't just about rising prices. It was about a collective sigh of relief that for now, a physical supply heart attack has been averted. U.S. equities staged a significant recovery today, reclaiming much of the ground lost during last week's volatility. The Dow led the charge, gaining 1.33%, while the S&P 500 and Nasdaq both closed over 1% higher. The real move, however, was in the inflation tax assets. Crude oil suffered a massive 9% plunge, the sharpest one-day drop in months. We also saw the U.S. 10-year yield retreat from its recent highs, settling back near 4.3%. Interestingly, gold continued to slide, falling another 2% to 4,414, suggesting that the frantic scramble for cash we saw last Friday is beginning to stabilize into a more orderly repositioning. The catalyst for this shift was a surprise diplomatic breakthrough. A 72-hour humanitarian corridor was announced for the Strait of Hormuz, allowing stranded tankers to finally exit the region. This immediately collapsed the shutdown premium that had been baked into oil prices. At the same time, the Federal Reserve began a coordinated damage control campaign. After last week's shock, Fed officials spent the day emphasizing that while they remain hawkish, they are also data-dependent and highly sensitive to financial stability. This effectively put a floor under the bond market. In the corporate world, we saw big tech hyperscalers like Microsoft and Google reiterate their massive AI infrastructure spending. This confirmed to investors that AI investment is a secular trend that remains insulated from these short-term macro shocks. Institutional money followed a path of tactical re-risking. We saw capital flood back into consumer discretionary and technology, sectors that benefit most from falling energy costs and stabilizing yields. Investors effectively unwound their bunker positions, pulling money out of healthcare and consumer staples to fund this return to growth. One open question investors are debating right now is whether this move reflects a genuine turning point in the crisis or just a temporary window of calm before the next escalation. I'd be interested to hear how you're interpreting this. Are you using this rally to add risk or to increase your cash levels? Let me know in the comments. Despite the green on the screens, a liquidity hangover remains. The fact that gold fell for another day suggests that the margin call pressure from last week hasn't fully cleared the system. The biggest fragility is the clock. This relief is built entirely on a 72-hour diplomatic window. If that corridor expires without a permanent deal, the snapback in oil prices could be more violent than the drop we saw today. The market is essentially shorting volatility right now in an environment where the underlying supply gap hasn't actually been fixed. Today's move signals a short-term narrative adjustment, but not necessarily a change in the medium-term regime. The market is testing the idea of a Goldilocks correction, where energy prices fall fast enough to prevent a recession, but slow enough to keep the Fed from having to hike rates further. However, the bigger message is that investors are starting to differentiate between sticky service inflation and volatile energy inflation. If energy stays down, the Fed has much more breathing room. The relief narrative faces its ultimate test in exactly 72 hours. We will be watching the Hormuz corridor expiration very closely. If the transit stops, today's rally will likely be viewed as a dead cat bounce. We are also watching U.S. durable goods orders on Wednesday and the critical PCE inflation data on Friday. If PCE comes in hot, it will validate the Fed's hawkish stance and likely end this equity rally abruptly. The broader takeaway from today's market reaction is that while the pressure valve has been released, the foundation of this rally is fragile. The energy crisis is paused, but it isn't solved. I'd be curious to hear how others are interpreting these signals. Do you think diplomacy wins out here, or is the market underestimating the geopolitical risk? If you enjoy this type of calm, analytical breakdown of global markets, consider subscribing. I publish regular briefings focused on the deeper forces shaping market behavior. Thank you for spending a few minutes here today. I appreciate you being part of the channel.